So let's do another example using the purchase, manage, sell model. The thing about the perpetuity model is that we assume we buy the company goes on in steady state forever, and then we live forever and enjoy the fruits of that company forever. The purchase, manage, sell model is a much more realistic model. So this is going to be where the team is going to come together and get the ownership and take over the debt of a company, and then manage it, own it, lend to it for some time, and then sell it and call in the loan. So this example is exactly what we looked at in the previous chapter as our second example, but now we're looking at it from the enterprise value point of view, from the point of view of the owners and the lenders, potential owners and potential lenders. So we want to know in this case, what is the DCF estimate of Supercontainer's enterprise value? So our PE firm and lender are going to team up and consider the purchase of SCI, Supercontainers Inc. And the features of the company are the same as they were before. It's well managed, steady, stable, so it is not going to be growing or shrinking in the next couple of years, well managed. So we can't do much really to improve its cost structure or things like that. And then finally, the equity is for sale. The ownership, the representation of 100% ownership, is for sale for $120 million. And just as we saw in the previous chapter, they've got revenue running around 150 million, depreciation, other expenses, their EBIT. Now this time they do have interest here because the company right now is being run with an 8% $80 million loan, and the firm's tax rate is 35%. So on 150 million in revenue, they have net income of about 15 million. That's pretty good. All right, so the current market situation, same as it was in the last example. The overall market for purchasing this type of company is in a big slump. But the great thing is SCI is in a classic baby thrown out with the bathwater situation. Despite that market problem, SCI has not had a decline in sales or anything like that. So SCI as a company hasn't declined, although its purchase price has gone down, which is great. So it's on sale. Also, the team believes that the market is going to recover in 2 years. So they want to buy low, sell high. And the strategy is going to be very similar to what it was in the last chapter. They're going to buy the equity and restructure the debt, so they'll pay off the principal to the current lender, and then the lender will give the company a new loan of $80 million. And they believe that the current debt to capital ratio is optimum. So the weighted average cost of capital is going to be optimum for the firm. So they're going to leave that alone, and they're going to run it for 2 years and sell it. And so they'll exit this investment by selling the ownership of the firm for 140 million. Remember, they're buying for 120. They estimate that the market will go up such that they can sell for 140 million in 2 years, and they'll call in the loan for the $80 million. So they'll make whoever buys the firm also have to go out and find a lender who will lend the company $80 million. So the way that they found the 140 million estimate is exactly the same way they did in the previous chapter. They got a bunch of PE ratios for comps, and they estimated the earnings 2 years out after the price slump, and et cetera, et cetera. So we don't have to worry about that because in this case, our general manager has done it for us. Let's go over the financing structure, remind ourselves of how this is all going to work. So D is going to be 80 million. They're going to pay off the old loan. The company will get $80 million to pay off that loan, and that'll be a new loan to the lending part of the team with the same interest rate. So let's say same interest rate also. And they're going to buy all the firm stock at the purchase price. That'll be E, and then D plus E is the total capitalization, and this is the enterprise value of the firm as purchased, and it's the market value. right? This is not our estimate of intrinsic value. This is clearly the market value, what we gotta pay for the firm today on the market. Okay, and as far as discount rates, so the interest rate is going to remain the same at 80%, and computed in our previous chapter, we have the RE from CAPM being 10.31%. Income tax rate for this company is 35%, and the weighted average cost of capital I've calculated for us, so we don't have to worry about it in calculating it for this example. So our job is to now understand and estimate what's our DCF estimate of the enterprise value of the company. And this, of course, should be SCI, not WCI, right? This is super containers, not work close Inc. To solve this, let's start with part A. So our DCF estimate for enterprise value, just go back to what we know, right? The enterprise value, all the enterprise value is the present value of every stinking cash flow that the team, meaning the lenders and the equity holders, are going to get out of this company for as long as it's owned by the equity holders. So in this case, we're going to have 2 years of free cash flow from operations, right? And we want to present value those by WACC. So that's why we have I equal 1 to 2 here, okay? And then we have the sale price that we're going to get. And that's going to include, because this is for everyone, what we get for selling the equity plus what we get back for calling in the loan. And we have to discount that back by 2 years because that's when we're planning to exit. Okay, the next thing we want to do is actually compute this free cash flow for years 1 and 2. And we remember our general formula here for free cash flows from an entity in the future that are simple companies that work with our simple accounting. And once again, as we had with Workclose Inc., since it's operating in steady state, all the assumptions we had for Workclose Inc. are going to work for this. And that means that the FCF D plus E for any given year is just equal to FCF. Free cash flows are going to be the same every year because it's a steady state company. And there is going to be, as we showed in the last example, just our NOPAT or 1 minus the tax rate times our EBIT. So just filling in here, as we know from our previous example, this 1 times the tax rate, 1 minus the tax rate times EBIT is completely equal to EBIT minus tax on EBIT. So algebraically, they're exactly the same thing. So let's look at it from an income statement-y point of view, a financial accounting kind of point of view. We've got the revenue, the depreciation, the other expenses. Then we can compute the EBIT, and the tax on the EBIT is what? So this is 35% of 30. We subtract that, and we get our NOPAT of 19.5. And then again, just to relate this to the general equation, in general, if the company was in steady state, there'd be some changes in working capital. We'd have to subtract that, add back our depreciation, subtract our CapEx. We don't have to do that here because if it's steady state, depreciation should equal CapEx, and we would wind up with our free cash flow to everybody. And again, in our simple case, that's just the NOPAT. So next thing we have to do, so we have our free cash flow, and now we need to get what we would call the terminal value. Okay, the terminal value is just the last cash flow we get from this thing, from selling it or whatever other terminal event we have. So in our case, it's selling it, okay? And what is our terminal value here? It is the sales proceeds that we get from selling 100% of the stock, and also the amount that comes in from the loan being called and repaid. So that's going to be the 140 million that someone at the private equity team has already estimated will be the sale price of the firm in 2 years after this recession for this type of stuff is over, and then the 80 million for getting the loan. And this is another one I can even do in my head. All right, so we have 80 plus 140 is 220 in most circles. Okay, and so now we're ready to compute the team's estimate of the enterprise value. So this would be our enterprise value, intrinsic value, our best guess at what the truth, the whole truth, and nothing but the truth really is for the enterprise value of this firm, which, as we know, is often very different than Mr. Market, and that's why you want to buy companies like this. Okay, so we're going to use our general equation for the purchase, manage, sell, okay, for 2 years, and we know that for both years, the free cash flow is our NOPAT, it's 19.5, and we know that the total proceeds we expect to get calling in the loan and selling the shares of stock is 220, and happily someone has already computed the weighted average cost of capital for us at 8.26%. So let's see if we can calculate this now. So we're going to have 19.5 divided by, well, let's see here, 1 plus 8.26% plus 19.5. That's going to be from operations for year 1 plus 1 plus 8.26%. And that's going to be for the second year. So that's squared. And plus at the end of the second year, we also get that 220 million. Okay, so that's exactly how you'd write it down on a piece of paper. And now let's take this and exactly as you would put it into your calculator, we will represent it in Excel. So you'd type it into your calculator like that. Then you'd hit compute and you get 222.36. So we got the intrinsic value estimate of the enterprise value, and with that, we're able to answer the question, should the team come together, purchase the stock, refinance the debt, give the company a new loan to do this deal? So let's see, the NPV, remember now, is just the present value of every stinking cash flow associated with this project, right? Including anything that we spend at t equals 0. So let's start with that. So at t equals 0, we have, as I've noted up here, the total amount of money that has to go out, cash flow out from the owners and from the lender. Okay, so that's our purchase price. That was our it was 120 for the equity and 80 for the current loan. So that adds up to 200. Okay, and then what we would get back is the intrinsic value EV, which we just estimated. If we do that, 222.36 minus 200 in most circles is equal to 22.36. So that's looking pretty good. So we conclude that the team should consider going for it because 22.36 is greater than 0. The NPV is greater than 0. And again, as always, I say consider here because this is what the model says. You want to do more work than just the numerical model on these. Okay, well, that really wraps it up for 15B. I'll look forward to catching up with you again very soon.